editor of Mint Money and a financial journalist. To my right, Lobai Navlakhi, founder and CEO of International Money Matters. So what we're trying to understand is, you've heard the previous presentation. I think we've got a very interesting landscape of how things look in coming years. It was a bit, I guess, more weighted towards equities, but I think now we'll try and understand how do you choose the right asset classes amongst the asset classes that are there in front of you, and how do you make a more informed decision about where you're going to put your money in for the next couple of years. So we'll go sequentially. So Vishal, do you want to speak for a few minutes on what are the kind of concerns, not concerns necessarily, but what are the parameters that one should be looking at while deciding where?
I think I'll probably start with a broader point, which is the need for asset allocation and what an advisor can do, since most of us are advisors in different categories. And I think that need is probably far more highlighted now over the last 4 or 5 years than it had ever happened in the heydays of the bull run. Because I think clearly, as we've seen in the bull run, anything you pick becomes gold. So why did you need to allocate, and what was the concept of risk, et cetera, et cetera. So all the boring concept of allocation are probably far better highlighted right through this last 4 or 5 years. And that's something that I think we have a great opportunity to sort of embed in the way we advise clients. And I think Nagu mentioned about expectation management. And I do think that the role of an advisor is quite central in doing that. So it's not just about returns, it's not just about how quickly you can multiply my money, but it's also significantly about how you manage the risk. And no better way to do that, as is proven globally, than allocate in a much more scientific manner than just take a strategic allocation and just apply a 50, 20, 30 or whatever principle that you have. So that's one point, which is this role is far more important now than it was in the past. And the advisor has the central responsibility, to my mind, to try and do that more scientifically than what we've done in the past. So it has to become more evolved. The second point, I think, that probably comes out of what has happened more recently over the last 3 or 4 years is that asset classes themselves evolve. And I think probably 10 years back, it was fair to say that Indian equity, Indian fixed income, and Indian cash was by and large how you would look at allocation, with different maturities and different taxation angles being put in. Now imagine where that allocation would be in today's world without gold, or what the opportunity could be with international equities or international commodities thrown in. So we must understand that the spectrum increase that we now have is actually quite good. Now, I'm not saying that one shouldn't be a bull on Indian equities. One should. But the fact is there is significant risk reduction that can be brought in by adding asset classes. And I think the last 4 or 5 years, where, especially in the last probably 18 months, when the rupee took a beating, I think that got highlighted, that people who were in international funds did much better. Or when certain commodities like food grains shot up or oil shot up, if you had ways to get into those sectors, because you were looking outside traditional asset classes, you did much better. So I think that's the other thing I want to bring out of what we see as asset allocators over the last 4 or 5 years, which is different from the past.
So I remember, I think I was seeing Prashant's slide, which showed that Indonesia was the best performing market among everything else. So
that's just a case in point. I don't know if you have an Indonesia dedicated fund as yet, but really it's about if you had that choice. Yeah. And I know there are a lot of ASEAN or China or US funds out there, global equities, etc. But the fact is you can't afford to ignore that.
And that's your advice really to the financial advisor community.
Yeah.
Right? Open up your mind, look at all the options.
If you can, of course, you have to take client considerations, can you research it, etc. But the fact is, much more asset classes available, so take a good look at that because they do really add value.
Govind, I'd like to take off from the previous session, and it's fantastic to hear about what India is going to achieve, 5th largest economy. You want to immediately increase your SIPs the minute you hear all of that. But I find such a large disconnect between, and all this is absolutely correct, it's correct. We all strongly believe that that is the way it's going to be. But that does not get translated into the average investor. So even when we are talking about asset allocation, these are still concepts which are very, very new, very kind of unique to people, they are unable to understand these basic concepts. And also related to that is the point that we are looking at somewhere people have this equity persona of a mutual fund. They do not see that a fund is really a door which takes you to different asset classes, equity, debt, gold. Real estate has not happened. There has been a problem of communicating these good, broad ideas to the retail investor. The retail investor is very focused on, which is part of the topic, the retail investor wants capital preservation and highest return. So when people go out to sell, or even when people call in to us as media or who write on mutual funds, their one desire is highest return chahiye par risk nahi. We don't want any risk, but we want the highest return. The role of the advisor is really to manage that expectation and get people to understand the whole basket approach. What is it that you could reasonably expect? And I think somewhere that introspection will have to happen for the fund industry, the producer of the product, of how best they're able to do that. And related to that has been the problem of products from other regulators, which is unfortunate. I mean, it's an externality, but every industry will have an externality. I think the fund industry has been too kind of in a room fighting with itself rather than go out as a unified body to take on these various problems. So the communication is so difficult with the final investor. Until that happens, we can talk all we want about asset allocation. But on the ground, you will still have people buying gold, real estate, and coming to equity when your PE ratios are 20, when the only thing is the Sensex growth. So that is the unfortunate part of this great story of India. You have pensioners in the US, Canada, who benefit from our growth, not Indians, which is something hopefully the new, if we get new regulations in place, would solve.
Okay, I think there was an interesting point someone was making, that are we in a way trapped with an older demographic, right, who has a sense of history weighing on them and therefore are very wary about investing in the markets, and if they invest, they have a certain pattern of investing. And I mean, the logic should say that the demographics are shifting and quite fast, but the people who invest in the markets are really of a certain age group, and therefore sort of constrained by history.
Look at, and the advisors could tell us better, what I understood a little bit about feedback on the TV shows and of investors. It's your 25 to 35-year-old investor who is really savvy. They've really understood the product, and they are your dedicated SIP investors. So again, that push to really get these people into it, because your 50-year-old investor is going to be cynical about all the scams that he's seen. But the younger investor is, they understand the product. That push to get more of these guys in, I've not seen that.
Yeah, okay. So that's what I was asking. I'm saying, so are there enough of those young investors coming into the universe which will perhaps counterbalance the skeptics who to have a point of view? But anyway, we'll continue that discussion. So,
I'm going to raise a question to the advisor community on asset allocation itself. Is that how equipped are we to advise our clients? So what is it that we are doing to upgrade our knowledge and awareness about asset allocation? Because when I came into this industry and I look back, say about 5 years ago, and I wanted to get 12-13% return for my client, I typically looked at a 50% allocation to equity and a 50% allocation to debt, and I got the 13%. Today, as Monica says, is that the client wants 30% in gold and 70% in debt, and he still gets a 13% allocation. And somewhere along the line, equity is forgotten totally. I think also taking off from the previous session, if we are going to believe, and I do also believe that there is going to be higher inflation with the amount of QE3 and all the quantitative easing money that is floating around in the marketplace, then asset classes which are going to beat inflation are things which people need to look at. So what is the rate of return that you had in the past? What was the rate of inflation in the past? And if inflation is going to go up, then your real return is actually going to drop. So are we looking at that at all? The other point is in the topic itself, which you are talking about both, growth as well as capital preservation. And as Monica said rightly, I think a lot of our clients, all of us who've been in business for some time know that in 2007, the same client wanted 100% of his money in equity. And in 2008 and 9, he was telling us, don't you know me? Why have you got, even 20% money or 40% money in equity? So I think the very important thing for us to do is, one, have the knowledge and the data points for returns, etc. But I think the big distinguishing factor that's going to come into play is what I think Nagnath mentioned towards the end, is behavioral finance. And I think how we tackle the client, what we communicate with him, how do we try and convince him to stay invested in equity even while, last 5-year returns are 5%, 8% compounded. How do you manage that? Because when growths actually move up, and nobody presented that slide, that if you are out of the market for 10 best days of the year, then your returns will probably be half of whatever returns you saw of the market. And combine that factor with the issue that investors will get into the equity markets only at the highest point in time, I think that becomes an issue. So coming back, I'm just saying is, what is our role? And if our role, I think if we look at from an advisor point of view, is that we will ensure that we protect all the clients' risks first. And that's our main objective. Then whatever returns we make will be positive. And if we are doing this and we are communicating that to the client correctly, then I don't think we'll have a problem with clients staying on or even adding to their equity allocation even while, say, returns are not very good.
Okay, Vishal, let me come back to you. So I think what we're trying to gather here is, what are the right assets that we should be allocating to, or investors should be allocating to? So why don't you have a
go? Unfortunately, no golden formula, and I except gold, yeah. And I do echo what Monica and Lavai mentioned, which is that in practice, it is very rare that you get the luxury of advising a customer that, for your 1 lakh rupees, buy this strategic asset allocation model that our researchers have brought up. Doesn't happen. We wish it did, but it doesn't happen. So really, it does become, how do you diversify, and how do you balance out clients' immediate concerns with what you believe is going to be better in the long term. The fact is, and we obviously in the fund management, when we talk to the manufacturers, the big push is, and like the fund managers brought out in the first session, that when equities are cheap, why aren't you guys advising clients to buy equity? I believe we do, but the fact is the client's not ready. So you have to take into consideration what the client wants, and it is not going to be the same thing every day. So even when the demographics or the risk appetite as we see it should not have changed, the reality is that before a rally and after a rally, things are very different. So to my mind, how do you achieve a strategic model becomes the bigger challenge for the industry, which is how do you actually get the client to a diversified situation? It's not as much about what the right model is, because that remains in theory. So I think first, of course, you must have a right model. So that's a starting point, which is a bit about doing the research and doing the hard stuff to say, okay, this is what different asset classes have done. Some amount of hard data, and some, Prashant shared that, in 20 years, bonds had done better than equity in India. Some of that data is very, very true. So you can't ignore bonds. You can't ignore liquidity. You can't, of course, equity has to be centerpiece at some point in time. But what else do you do to manage risk around is fundamentals. Like I said, can you use some international equity to manage currency risk? Not that the client has a currency exposure today, but how do you know what's going to happen tomorrow? How do you take advantage of some other opportunities that are coming up? So that forms, to my mind, the bedrock of what you're trying to do. But the big challenge is, how do you execute with a customer who today, no matter what you say about P being very low, etc., but if the news flow is going to be so negative and you believe this is only transient, the fact is he's not writing the check for an equity fund. So that's the bigger challenge, I would think.
A slightly larger question. So you talked about expanding one's horizon and looking at new opportunities or new allocation. I mean, they may not be new in the new sense, but they're beyond what is currently being considered. So should folks here first focus on the traditional allocation opportunities or areas, or should they be getting adventurous and looking at 3 more things or 4 more things, including currency, which in any case people are not going to listen to?
Yeah, again, no silver bullet for this, but I think should you be looking at a strategic asset allocation? Yes, you should. But how do you go about doing it when the bedrock of that allocation is not something that the customer is open to? So sometimes maybe a marginal approach, which is what do you do with this small lump sum relative to the larger whole, becomes a better way to ease the customer into a more diversified portfolio, right? So I know that, yes, this customer should be, let's say, 50% in Indian equities as an example, right? But the fact is he's got nothing right now. So how do you gradually build this customer from, and given his current state, which is very risk averse, to a larger Indian equity proportion? That becomes, to my mind, so to answer your question, should you be focusing on strategic first? Absolutely. But all I'm also saying is don't ignore the tactical, because it can help you get into the strategic eventually. Because if the strategic opportunity right now is maybe something slightly more here and now, then maybe that's an entry point to get the customer what you eventually think is good for him.
So Lobai, let me ask you a slightly harder question. I mean, are personal financial advisors failing to communicate or impress upon their customers or your clients what the real opportunities are?
I can't answer for everybody. I think there's obviously a gap between what we know and what we need to communicate with clients. But I think one of the things that I want to just share, I have some data of the US because I attended a FPA conference recently, which may put some things in perspective. I think the way we communicate is definitely an issue, because in the US we have seen a significant fall in the markets as well in the last few years. But they have data to show that the 401k investment, which is a long-term pension investments, I think if I remember the statistic right, 95% of the 401k investments, neither the contribution amount nor the allocation was changed by investors, because they thought of this as a really long-term product and this is something for retirement. So yeah, it can go up and down, but ultimately it's intended for long-term, so I'll not touch it. But everything else that you can touch and feel, you sort of want to grab. And I have given this example in some previous sessions before, is that if actually the equity market had no ticker, we would be much better off. Because when we buy property, we don't go out and look outside our door that today the property price, which we bought at 2,700 rupees a square foot, is 2,683. I'm sure we would panic if we had such a situation. We don't have that situation, so we stay invested, and we always say that property is a fantastic investment. But I think we should genuinely look at those who invested in property in 1996 or 97, because I just remembered Prashant's slide of the Sensex. It's today the index is 6 times. I'm not really very sure whether all properties or some properties or most properties have given you 6 times returns in these last 15 years. So I think it's a question of perspective of what is it that we are looking at, what is it we are communicating, and that changes the whole game. If you are only going to focus on return, then there's a problem. In 2007, if we told clients you're going to get 12% return, they say, no, XYZ is telling me 35%, why will I come with you? Today, if you tell him 12%, he'll say, of course, I'm coming with you. Everybody else is telling me 8%. So I think it's a question of time. So I don't know whether I've answered your question, but
Not
yeah.
Really, but anyway.
Yeah.
So Monica, why don't you take a shot at this? How do you convince people, or let me put it another way, are the intermediaries doing the right kind of convincing, and do they have sufficient body of knowledge and experience? And that could apply to investors as well.
I think it started off as commission agents, and commission agents will only look after their commissions. So I think we also need to look at this industry as something which is growing. It is beginning to understand that it needs to add value to itself. You have to move up the value chain to be able to give a financial solution to a person and not hit him with a product and then hit him with something else. So I think there's a learning curve. People are understanding. Those who disagree with doing that much homework themselves are exiting the market. So if the ARN numbers are going down, I don't see it as such a big problem in terms of fewer number of feet on the street. What is the quality of the people which are left? If some interactions with some of the advisors are of any merit, I think it's really improving because of the changes we've seen in the mutual fund industry with commissions, with regulations. So I think it's an evolving story, and the people who are either coming in now or left behind have understood that they're going to solve somebody's financial problem, and they're there for a lifetime. It's 30, 40 years relationship that you're looking at. Now, the minute you have that in your mind, I think the way that you're going to talk to that person changes. You are going to say that, okay, you are invested into real estate, you have your fixed deposits, you have gold. This year, let's start with you. Why don't you put 5,000 rupees a month into this SIP? That's all that I'm asking. You've got maybe a lakh surplus. Let's begin with 5,000. You should have the confidence that next year when you come back, that 5,000 will become maybe 15, and 10 years later you're getting a larger and larger share.
You're seeing a positive trend in this on both sides.
I see a
investors
positive trend
making a move,
where
and
all I'm saying is that the advisors have to understand that that is the way it's going to be. Across the world, people are moving out of the commission model. So if you keep on hankering for that 2%, 3%, 1% commission, you can go on fighting with yourself and the system. But if you understand that the customer is not a fool, if convinced, people say that you need a 40% commission to sell life insurance. The person who truly understands the merit of life insurance will queue up to buy term cover, because you're so scared what's going to happen to your family if you die that you will actually go out and buy it yourself. It's just that the way that our industry is being structured is all wrong. And to correct that will take a long time. The smart advisors have understood that they're in the business of financial solutions, and it's a lifetime approach.
So you did about a communication problem, right? Earlier. So how does one fix that? And I also know that this is a subject at every such discussion, right? So what's your current view on it?
How do you solve the communication problem? Yeah. One is that the funds will have to do a little more in terms of pushing across the message that this is a long-term product, this is how it works, and this is something that I really passionately believe. The person who will really educate the customer is the advisor, the seller. There can be no sale of financial product which does not have advice embedded into it. It is wrong to say that a person can be a vendor. When the client comes in, he's not going to say, I want to buy 1, 2, 3. He's going to say, Kya, what do you think I should buy? And that interaction is your moment of financial literacy. So you can spend crores on seminars which do nothing for financial literacy. But that interaction between the advisor and the customer is so crucial. How do you get that advisor to look after the customer? That is, if you solve that, it's what kind of products do you launch? So when you had your 6% amortization, it is this industry which launched, let's not name fund houses, but 10 Me Too broad equity funds, 5 tax funds. So it's the same industry which did that. So if you're going to be chasing the NFO money, which they did, you will end up in a market like this today where people don't trust you. So right now you're suffering for what you did in the past. There are fund houses which did not do that. There were speakers in the earlier session which were part of that, and they see the fund flows coming in.
Lubai, we're trying to ask a question about, what are the right asset classes to choose? And I think some people here want to go back with something. So what are your thoughts?
So like I said, I think it's not one answer which is going to, which everyone has to carry back. And I think even if each one carries back that one answer, it will be a different answer for each client. It ultimately gets down to what the client goals are. And my thought process is, if you can break down what the client requirement is and try and say, okay, this is the amount that he needs in the short term. What am I going to do with that money? And I do something very safe with that. Long-term money, when I have long-term money is when I really need to look at what the asset allocation is going to be. That for the long term, what do I need to do? To take up with what Vishal said, there will be a strategic asset allocation that for meeting all these long-term goals, I require 10% per annum. So I want, and I'm assuming equity will give me X, gold will give me Y, foreign assets will give me Z, etc. So I'll break up that asset allocation, and that's my strategic asset allocation. But as markets change and returns change, and the communication with the client changes, that is, his BP goes up and he's feeling more tense than some other client, then for that client, you will probably reduce the equity asset allocation at that point in time just to keep him going for some time. So it's pretty much like a test match where you have a fantastic bowler bowling and you're not able to play the ball. It's okay, you can play out a few maiden overs, the other guy you will score from, or later on you will score. And I think that is the approach. I think something what Monica said as well, that we are running the marathon and not running the 100 meters. So if you approach things from that point of view, I think it becomes very simple. And also very important, as I mentioned earlier, about the knowledge bit. So every client interaction that you have is an opportunity for you to learn so that you can implement it with the next client. So I think it's a continuous process.
So the question is, we've seen, I don't know how many cycles you would finally categorize them into, but we've seen a few cycles. We've also seen money mostly moving in one direction, right? Either from from nothing to equities or from equities to gold and gold to wherever it will go next. Is there enough evidence and knowledge to show that investors could finally be opening up and maturing, or are we still too early to call that?
No, so I think from our experience and my experience, I would say that if I devote the time with a client or a prospect, say the first 2 or 3 meetings to understand what is it that he really wants and to share with him that this is our approach, then I think that's a very strong footing that you start with. So I would say with majority of our clients, we've not had an issue that, in this market to get money into equity or to increase the SIP allocation, because that's what is required. I may not increase that SIP allocation to the extent that I required to because of a tactical reason. Okay, I'm doing little lesser, or he's never experienced it before, so let him first see, a black on his report before he sees red. And if he sees that, then he will get convinced and he will add more. So that's a little bit of the marketing bit comes in, I suppose. But I think if you approach it like this, I don't see a problem. I don't see particularly a problem.
Okay, so Monica, at this point of time, what is your sense? I mean, is it capital preservation, or is it people beginning now to say maybe I should get back into looking at returns?
There is always, at the beginning of a bull run, there is always, people are still reluctant. So when, I think Sensex moved up about 1,000 points in the last 4 weeks. So you see the beginnings of interest in people, but the transformation of that interest into actually putting money down, it needs facilitation. It is so difficult even of people who know to actually put that money down. So that it is so important for that conversion to take place. So yes, I think in every interaction everybody has, you see the great interest. But it's a kind of a misguided interest. They don't know what to do about that interest. They don't know what to pick up. They don't have the confidence in trusting either a fund house or the advisor. So I think there's a very deep, wide pool of money with the retail investor. You just need the right channels to get to it. So the interest is there deeply in equity. Because when you do talk about, see, you have to, again, the communication has to be about the country, about saying that, who's going to grow in the next 30 years. So we don't have Bijli, Pani, Makan, we don't have all of that. When all of that gets created, who's going to make it? Where does the money come? So when the understanding is there, that finally that money comes to the companies, to the markets, that conversion from that belief that yes, equity does well over the long term into products, that is your missing link. So the interest, I think, is there very strongly. How do we convert that?
Okay, any questions? Yes, ma'am.
which would incorporate debt, equity and gold would be a safer option rather, or to create your own asset allocation depending on the risk profile of the client, because we do have various fund of funds as well, which would be equally divided, or some sort of division as a fund manager would see fit, depending on the economic scenario at the point of time.
Yeah, I think, a great question. And I do think that if we find a simpler but efficient way to offer an allocation rather than individual products, then it may be a good way to sort of get the client started. So a fund of fund or anything packaged with lower risk and therefore, technically better for the customer may be a good way through. It also has to do with client's own maturity. Because the challenge that we face often is that you start off with a fund of funds, and with downside markets, you're able to go back and say, look, you're better off because you did not lose as much. But when a rally or a bull market or something like that starts off, that's when everything gets a bit more foggy, because then the customer starts comparing, and then they say, look, your fund is only giving me 10%. Well, this big fund manager has produced 18% return. That's when we get tempted. So I do think that fundamentally it's a good entry point. So if we look at diversification, from equity to equity mutual funds, great level of diversification. From equity mutual funds to an asset allocated product, fund of fund does the job quite well, if it can be done efficiently from a fee standpoint. So good entry point, but we have to obviously come back to education and expectation management, which is where I think the trick lies.
Microphone. Yeah, I'll just come to you.
Shall I take first?
Yeah, go ahead.
Good morning. My name is Sadiq. I'm from Network FP. My question to the panel is, as a financial advisor, should we be basing the asset allocation, which is the subject we are speaking, on the risk profile of the clients, which actually changes based on the market changes? Or should it be based on the time horizon of the goals and his needs?
Next question there.
Hi, this is Deven. My question is for Vishal. In Prashant's slide, he showed the 10-20 year, data where about the mistiming of the market, to which you said that, you tell clients to buy when the valuation is low, but the client is not ready. Now, don't you think it's a huge failure as an advisor? And, it's not to you, but to the whole community as such. And the related question is, how much of it is linked to the mis-selling which has happened in the past? And what has the industry done collectively to fix that?
Okay, Vishal, I'll just get one or two more questions and then we'll this thing. Anyone else?
Hi, this is Mukesh Dedia here. The issue is about the asset allocation arises because of the expectations. Now, we have been doing asset allocations based upon the expected returns. If, as Monica said, that the client would always say that I want the lowest risk and the maximum returns. If rather than concentrating on the expected returns, if we do the risk profiling on the risk he wants to take, obviously he's going to say that the risk I want to be on the lower side, and give him products or asset allocation depending upon risk. Now, why I want to lay stress on this is the risk of the various markets are going to be different at different points of time. When the P ratio is 10, probably the equity markets could be at the lowest spectrum of the risk. Whereas when the interest rates are lower, debt markets are going to be at the highest level of the risk. So certain quant models need to be built up where it takes into account this dynamic nature of the risk. When we talk of volatility, that is standard deviation, it talks about both the sides. But if you take volatility only on the negative side, those models would help us actually give positive returns or absolute returns to the client. So this is where the industry needs to mature.
Thank you. Yes.
Yeah. This is a question directed at Vishal and Loai, and I'm not sure whether it's a question or a comment or a dilemma. But it sort of precedes this whole business of asset allocation. It's great to talk about asset allocation, strategic asset allocation, dynamic asset allocation, so on and so forth. But the reality is that the clients, that investors have been bitten so many times that they're really shy. And in all likelihood, and this is empirical data I'm sure supports this, any advisor would have not more than maybe 15 to 20% of their clients sharing their entire wallet with them. So this whole asset allocation business actually gets completely, colored the moment you're only managing a very small part or even a larger part, even 50% of his portfolio for asset allocating, it's only good for 50%, right? So you really don't know, what's happening because that guy also wants to play one against the other, right? I mean, the investors also smartened up over the last few years. He says, I will deal with 3 financial advisors, right? So, what's this whole business of asset allocation? How does it pan out if you're not really looking, you don't have a bird's eye view of the overall portfolio, which is the reality in majority of investors. So that's really a dilemma actually, more than a question.
Okay, anyone else? Yeah, let me finish a few, yeah.
This is a question for Monica. You are a member of this advisory committee in SEBI. So can you throw some light on this direct and all those things which is affecting the IFA directly? And how you arrived all those things, please?
Yeah. Hello.
Yeah.
Excuse me, sir.
Yes.
Yeah, good morning, sir. One thing which I understand, like where we lacking is the projected return normally we explain to our client. Like in the earlier panel, our dignitaries spoke about the projected earnings growth of 15 to 17% over a period of 4 to 5 years. That's what we had been doing for last so many years. And last 5 years, if you see, the things are reversed. It's not the same. The same thing is happening again. Like we are standing at say 18,000 level market and we are again projecting for 5 years. So what I understand that equities will not be projected for 3 to 5 years rather than be a longer period, say 10 years. That can be a very sustainable period to sell the schemes to our client. Because 5 years down the line also you can't see, because these dignitaries who had now projecting 15, 17%, 5 years back also they must have said the same thing. And the real results are in front of us. So that is what I feel, like we can sell the equity funds for a longer perspective, say average 10 years rather than 3 to 5 years. So over a period of that time, the things will span out evenly. Thank you, sir.
Thank you. Vishal, so do you want to take up the first of those questions, the risk profile versus and the issue about mis-selling?
Yeah, I think, so the first question around whether it should be goal-based risk or current, emotional risk. As in, while you cannot rule out the latter, I think it has to be goal-based. And that's where I know it is easier said than done, but that's where I think all our skills and the behavioral, aspects need to be brought in. And quickly on the second one, I do think that as an advisory community, we do have a great opportunity. No, we are not perfect, and to Sriram's point, yes, we are not getting a full view of the complete allocation to do anything scientifically, but the fact is, we are far better today than we were 5 years back, for 2 fundamental reasons. One, the bulk of the advisory industry has now seen a protracted bear market or a highly volatile market, which increases the appreciation for risk management, which I guess was not as clearly appreciated in the heydays. And the second is, to Monica's earlier point, the people standing now are really committed. So because of this consolidated phase or consolidation phase, I do think that the average quality that we have left in the industry is significantly higher. So to that end, is there a greater opportunity for us? Absolutely, because one, the client now understands the concept of risk management. Expectations are far more real than in the past. And the temptation of comparing 2 advisors and 3 advisors and saying, this guy got me better returns, the clients also wisened up that this is not a one-way street. The second is the advisors are far more committed and much more mature now. So I think these two factors actually play quite well for the future.
Can I just add?
Yeah.
That I think my comment was more for the independent advisors. I think the banking channel, I'm sorry, is still mis-selling greatly. You look at the number of money in, money out, it's almost the same. So the churn still happens, that's again because of regulatory arbitrage, but the banking channel I think has had no lessons, and that actually is harming the industry. So if you look at the inflow-outflow numbers of IFAs, they are very healthy. But you do the same thing for banks, and you again look at commission structures, you will see why the mis-selling still happens. So I think that part of that industry still has to get regulated properly.
Can you give me an example of mis-selling?
Oh, churn. How do I generate? This is the AUM that I have of my banking mutual fund customers. So if I have 100, if 5 I will churn, I will get so much. So this 5 I will churn this quarter, this 5 I will churn this quarter. So how do I milk another, and because there is a trail which becomes the commission, so how do I get that? So how do I milk them for another 50 basis points? So that is a conversation which we know which happens in banks, which is unfortunate that there's a regulatory arbitrage and we are not being able to sort that out. But I think the value add has happened in the advisor community rather than the banking community because they change jobs.
Vishal is the only member of the banking community.
Difficult to either defend or want to defend, a large community. So I think obviously we'll have to look at data very, very carefully. Not sure about the regulatory arbitrage, which is, it is regulated exactly the same way. And I'm sure that where someone has a reason to go back and tell the customer that, exit this, enter this, there must be a good reason. Now, every bank manages that process, to my mind, to the best of its ability. Like in any sales machine, whether it is, in FMCGs or whether it is in white goods, I'm not sure that any industry has all great apples. So I would not defend, the industry per se, but I think that's something that is quite real that we have to deal with. Yes, it does get seen in a different way, but have we not seen IFAs or any other part of distributors not have issues? Yeah, there are issues all around.
Okay, Novak, can you talk about this whole sharing the wallet conundrum that I think someone pointed out? Is that an issue that you face? I mean, it seems fairly real to me, and should one be concerned at all?
From my experience, I used to be a very, I still am, idealistic person. And in the early days, I would tell clients that if you are not going to share 100% of your wallet, I don't want you as a customer. And I lost, I think, a few big clients because they said, how do I trust you with all my money? If you try out and you tell me how you've done with the smaller part, then I will, add the money to you later on. So I sort of arrived at something which is probably a little more acceptable to him as well as to me, is that I tell the customer today, and maybe you can share this and this could be your learning from this session, is that I tell him that you need a master financial planner. That master financial planner need not be me. It need not be any advisor. It could be you yourself. But somebody there has to keep an overall control on the allocation, strategically, tactically, whatever you want to say it. I mean, if you're going to drive and say, I am the customer, but I am my own financial advisor, I am giving you 20% of my wallet, and you run it as purely capital preservation, then you evaluate me on that and not evaluate me versus somebody else who is working on growth. But I think if you communicate this correctly, you will probably get to be the master financial planner. And today, I don't have the statistic, but I think 90% of my client will be, if not managing 100% of the wallet, we will know 100% of the wallet, and we control pretty much what that person is doing with that 20 or 30% which is running through another advisor. Where is that money getting invested? Or when it's invested, he's communicating that back to me. So simple, again, a very practical solution. If you can figure out with the client that when you're discussing with him every 3 months on his portfolio, can you make him a net worth statement? And if you have to make a net worth statement, you put in yours and you say, please give me the other data. I'm just going to give you an asset allocation table. Okay. You'll pretty much become the master financial planner. I don't think there is an issue. It's a issue within us in terms of how we communicate what we are pitching for.
Okay. You had a question about your role in SEBI.
No, I think the question was about the direct plan, which is, I think, really upsetting the sellers of funds, the IFAs. So I'm not allowed to actually authorize to speak about that, which is an odd comment for a media person to give, but I cannot.
Precisely why you should be speaking.
No, so I cannot talk about the direct plan because it's still being decided and all of that, except that I don't understand the worry. If you are giving value, so I don't know whether it's coming or not coming, but if there is value being given by an advisor as a financial planner, why do you think that your client base will leave you? You know, what makes you insecure? If there is value, if he trusts you, if he's invested with you all these years, why would he want to go away and do it himself? Because investing yourself is full of problems in terms of managing it, looking at the statement. The role of the advisor is to take that worry away from the person so he is able to, you know, go play squash, tennis and do whatever, and that headache is really yours as the advisor. If he's thinking of taking that money away, so again, it's introspection. Have I done something? Is it limited what I'm giving him? Is there some other service that I can give him? Could I be hiring a CA and filing his tax return? Could I be helping him get a home loan? So I think we have to get out of the narrow box of saying, okay, I'm a vendor of mutual funds. The nudge is, once he trusts you, once the family trusts you, you can actually increase the relationship across other products. So what stops you from hiring a CA? What stops you from hiring somebody to look after the home loan portfolio? So I think it's, each time a challenge like this comes, it's an opportunity to upgrade what you do.
Some sort of feedback from the IFA community, since our industry is very nascent as till date. Or some sort of news coming also from the regulators to trust the IFAs and the same information that you gave us, because us telling our clients that, but it coming from the AMCs or from SEBI would have much more value. So would that be a feedback that you could also take back on our behalf?
Also, I think it's a very positive step if the community itself begins to talk to the regulator and policymakers as a group. Because again, what that no load has done is nudged the industry into grouping together. Now, again, it's a myth that regulators will not listen, nothing will happen. That nothing will happen is true because nothing is asked of. So if there is a consolidated effort to ask for reasonable things and have a point of view, I don't think it is not heard. So I think it's positive that it's coming together, the IFAs are coming together, they're forming bodies which then have a voice. So those voices are then held. You cannot talk to 5,000 people. You will always talk to a body which is representing that community. So it's very positive that this is happening, and that's the way to actually interact with the regulator.
Okay, we are
Can
running out of time now.
Can I say something?
40 minutes. Yeah, I'll take your question. I think so. We just go for the last round of questions, and please keep it very short. Okay, we've run out of time completely.
We're running 40 minutes late, and so I'd request you to kind of conclude it here.
Okay, good. So no questions. Thank you very much. But I'm going to ask our panelists to give me a quick 1-minute sum up on what you've taken away from both the previous session and this one, and how you would advise your clients, or what you would tell people to advise their clients on the right strategies for asset allocation. All in 30 seconds.
In 30 seconds?
Okay, 45 then.
45. Okay, one, I think it... Mike, 4. I think the important thing to take away is that we need to invest a lot more in ourselves. We need to be far more knowledgeable on our own, spend more time with the client before he signs up with you, spend more time communicating with the client, his behavioral issues. And I think the long-term story is pretty much intact. We wouldn't be all in this room if we didn't believe in that. From my experiences and interactions with people abroad, also I think there's a fairly positive look on India. So I don't think Indian market is going away anywhere, and I think it's time we capitalize on that.
Okay. Monica?
I think the time to be defensive about who you are and what you sell is over. You have to be more aggressive. You have to have more confidence in the work that you do and the value that you bring. Only if you have that confidence, that whole victim mentality has to go away, that there is a problem, they are out to get us. So if that goes away, you stop being the victim and you're a solution provider, that I think is the crucial psychological shift that the community needs to take.
Vishal?
I think, in the context of the topic, I think the value of diversification, the value of risk management is really something that the last phase in the market has probably made it even more significant. So time for us to actually show this value to customers and diversify portfolios across asset classes much more than maybe what we've done in the past.
Got a fairly good, I think, between these two sessions, a sense of where the market is headed, what are the constituents of the market, the companies within them, how they're going to perform, and of course, all the asset classes that contribute to the way wealth could be managed or will be managed in coming years. I thank all our panelists, the present and the past, for giving us this absolutely terrific insight into how you could advise your clients and advise them to essentially grow their wealth and make more money. Thank you very much.